Hello everybody. Firstly, I'd just like to welcome you to this webinar. We'll be talking about crude oil and whether its recovery after hitting an all-time low can continue in the midst of the economic impact of the coronavirus. My name is Sasha and I'm a financial analyst from the research department at Fortrade. Delighted to have you with us. If you have any questions, please call us and ask to speak to a senior account manager who'll be happy to help. Before I go any further, please take a moment to read our risk warning and disclaimer. I'm sure you know that although gains can be made trading CFDs, losses can be incurred too, and you need to be aware of this. And now, let me explain what a market opportunity is, if you don't know. A market opportunity is a one-page briefing containing market analysis, and our goal is to provide you with a simple-to-understand opportunity to trade in the markets. We will select an instrument such as gold or a currency pair and tell you our very best estimate on its price direction so that you can trade on it if you want to. Market opportunities are produced by the research department on a daily basis according to market conditions. A market opportunity consists of fundamental analysis, geopolitical events, and technical analysis that includes a pivot point and support and resistance levels. It's important to understand it's your decision whether you want to trade on market opportunities or not. Here's an example of a recent market opportunity. You can see some fundamental analysis on what's going on with the euro-dollar currency pair. You can see that this is a downtrend opportunity over a weekly period, since our analysis suggests the euro would decline in value against the dollar. At the top, you can see some geopolitical events and fundamental analysis that can influence the euro-dollar currency pair. For example, the part on the EU and its disagreement with the Italian government over its budget, which has put pressure on the euro in the past. When using a market opportunity, it's vital to look at the pivot point on which the calculations are based. In this instance, if the price reaches 1.1381 that you can see on the right-hand side of the screen here, this shows the right moment in our estimation for opening a trading position. That's how you decided to trade on this market opportunity when it was active. You can see below the trend direction and the time period. It's also important that you know how to use these stop loss and take profit options. You have support and resistance levels further along. At these points you can put a stop loss and take profit, and further down you have calculations. If you close the position using take profit, you can expect these kinds of profits at the support levels in green. If the price is going against you, you can potentially have a loss of this amount at the resistance levels marked in red. Finally, profit and loss calculations are based on a one-lot trading volume. So let's talk briefly about OPEC recent developments, then we'll cover what's going on with prices at the moment. So it's important to understand the role of the Organization of Petroleum Exporting Countries, which includes many of the largest oil producers in the world, including Saudi Arabia, OPEC's key player. The organization generates some 44% of all world oil production. It agrees jointly whether to increase the production of oil, which should influence prices down, or to cut oil production, which should help push prices up. The previous production deal limited production to 1.2 million barrels a day. The OPEC deal expired on March the 31st, 2020. So the last OPEC meeting, or now the one before last, was highly anticipated since Russia had already shown it wasn't willing to make production cuts. This put pressure on crude prices before the meeting, but prices plummeted after Russia refused to approve OPEC's proposal to cut production by an additional 1.5 million barrels per day. So the coronavirus, the lack of crude demand, and lack of an OPEC agreement that is oversupply combined to push oil prices as low as $19.2 per barrel on March the 30th. OPEC and Russia met at an emergency virtual meeting on April the 9th, after intervention from President Trump. In fact, on April the 2nd, crude prices jumped up by 24%, its highest ever one-day gain, after Trump tweeted that Saudi Arabia and Russia agreed in principle to a 10 million barrel cut. However, both Saudi and Russia told Trump to put pressure on US shale companies to cut production too. But no deal was reached on April the 9th or April the 10th, and crude prices slumped. Finally, a deal was reached on April the 12th. The deal was to cut output by 9.7 million barrels per day to support oil prices, representing around 10% of global supply. Analysts had hoped that OPEC Plus would cut almost 15 million barrels per day. But there was progress on getting the United States, Canada, Brazil, and Norway to commit to cutting a further 5% or 5 million barrels per day. Investors were not overly impressed with the deal at first. You can see that prices sank on April the 10th and 11th as fearful investors worried there might be no deal. On market opening, you can see how crude oil prices bounced higher, but fell again to between $22 to $23. Markets didn't believe that the cut was enough to offset declining demand caused by the economic impact of the coronavirus. Many traders believed that crude oil had further to fall. On April the 21st, crude oil prices slipped to all-time lows. On the demand side, the world had come to a standstill, with economic activity and demand for crude oil at very low levels, as everybody stayed at home and international air travel stopped. On the supply side, there was a consensus among investors that the OPEC deal was not enough to stop prices falling. There were reports that existing oil storage was filling up, and soon there would be nowhere to put unused oil. Instead, a number of container ships floated offshore, being used as an offshore storage for crude oil. At the same time, crude oil prices rolled over from one month's contract to the next, causing a sell-off that actually sent the previous month's contract into negative territory, below zero, something never seen before in the history of crude. On our platform, you can see crude bottom out at around $6.44. On this chart, we can see how happy oil bulls have been following the turnaround in crude oil prices over the past 7 weeks, as the commodity re-entered an uptrend after hitting that low on April the 21st. Although crude prices are far from last year's prices, crude oil has recently hit a 3-month high. Over the past month alone, crude oil prices are up by over 55%. So, what is supporting crude prices? Bloomberg reported that Chinese oil demand is now at levels before the coronavirus hit the economy of around 30 million barrels per day. It's anticipated that other countries will follow this pattern relatively quickly as economic activity sharply increases. We have the OPEC cuts. Saudi Arabia and other OPEC countries also made additional voluntary production cuts of their own. Anticipation that OPEC will prolong its existing production cut deal. We'll come back to this in a moment. US shale companies cut production. Some also closed after going bankrupt since prices were so low they couldn't afford to compete. Both US crude oil stocks and inventories have been positive, suggesting that demand is picking up and supply is slowing. So, what can we expect now after OPEC and OPEC Plus held their meeting early on June the 6th? So last week, reports emerged that OPEC may decide to meet early, which pushed prices higher. But confirmation of an early meeting was not seen until Friday last week. In fact, traders were hugely relieved since there were reports of disagreement among OPEC members, leading to fears that even the scheduled meeting might be cancelled, mainly due to the lack of compliance by some OPEC members. Adding to tensions, Saudi Arabia, Kuwait, and the United Arab Emirates stated earlier in the week they would not continue with their voluntary production cuts. This has been confirmed since. However, OPEC indeed met and agreed to extend its existing production cut deal of 9.7 million barrels per day until the end of July. Nigeria, Iraq, and other countries that have dragged their feet on cutting oil production were told and agreed to step back into line. Another important agreement that traders welcomed was that OPEC will now hold monthly meetings, ensuring there are less delays in adjusting the flow of oil if market conditions change. But overall, there was a sense of relief that Russia agreed to sign up, with many investors remembering Russia's refusal to cut production in the previous meeting, which created a price war and saw crude prices fall to those historic lows. So what's next for crude oil prices? For the time being, with the prolonged OPEC deal on the supply side, crude oil prices are supported. Global supplies of oil are being brought under control according to the current data. But the demand side holds greater potential for oil prices. Any promise of a quick global recovery, which will see an increase in demand, would be positive for oil. On Friday, investors saw much better than expected jobs data in the US, with unemployment falling. It appears as if at least some of those made unemployed will be re-employed quickly. If this happens, it's expected that people return to their former spending habits quickly, which would suggest a sharp increase in oil demand. It's early days, but traders will be watching economic data very closely over the next few weeks. Well, I hope you found this webinar useful. Of course, we at ForeTrade will be following developments related to crude oil in what promises to be a busy week's trading. Please get in touch with your senior account manager for further information. Until next time, goodbye, and please join us at ForeTrade again soon.